Guys, I'm about to deliver to you the best exit plan video on the entire internet. A video to where if you just apply these principles that I'm going to cover in this video, you will be a successful investor for the rest of your life, because these principles have worked since the dawn of investing and they will continue to work for as long as investing is around. I'm not going to say you're not going to win some investments, you're not going to lose some, but if you follow what I'm about to talk about in this video, it'll be close to impossible for you guys to lose long term. So in this video, we're going to be covering all things exit strategies and take profit plans. I'm going to cover 3 different triggers that you guys can use to take profits. And at the end, I'm going to go over a little something extra. So stay tuned. And at the end, I'm going to give you an extra trigger that you can use to, turn your profits up a little more. So definitely stay tuned to the end. Without further ado, let's get into the content. So the most important thing that you want to start with before you look at anything is the Federal Reserve, because they control interest rates and they control the money supply. And these directly affect all investment landscapes of all industries. And if you don't know how to keep up with the Federal Reserve, you don't know what to look for, subscribe to Know It Alls here on YouTube. We cover the Fed and what they're doing every single week. That channel is designed to give you a macro view of the market so you can take that information and translate it into strong portfolios. This channel is more specific to principles and actual DeFi strategies, yield farming strategies, etc., etc. So the first thing, start with the Federal Reserve. After that, you want to set up your different take profit triggers, all right? Let's cover the first one. The first one, as you'll probably guess, as I've covered on this channel many times, is a price trigger. So let's say you buy asset A. How do you come up with a price to sell it at? Well, the first thing you want to know how to do is conduct proper fundamental analysis. Fundamental analysis basically shows you if this is a good asset to buy or not. Look at the competitors that they're competing with. You want to look at the market cap and the fully diluted valuation, how they stack up to their competitors, their tokenomics, their team, all these different things that we show you how to do in our course. Then after you master fundamental analysis and you're saying, hey, this is a good asset to buy, the next thing you need to learn how to do is to know how to conduct proper technical analysis, which is the art of reading the chart. You need to know how to spot trends, how to look at, high liquidity levels, support and resistance, and things like that. After you learn that, then and only then can you pick your price triggers, right? And I'm sure you've heard this all the time. You don't want to use your emotions when you're investing. Well, that's really vague. What the actual truth is, you want to use your emotions when you're coming up with your take profit strategy, not when you're thinking about, oh, if I should sell here when something's going up, or should I buy here when something's going down, or anything like that. As a general rule, there are 2 types of investors. And you can mix these 2 and, it varies a little bit, but as a general rule, there's 2. There's investor A, who likes large amounts of profits less frequently. And then there is investor B, who likes small amounts of profits more frequently. And as you're going through your take profit strategy and you're like, okay, I bought this at 10 cents. I want to wait for a 5x and wait for it to hit 50 cents, or I want to wait to 100x, or maybe I don't want to wait to a 2x. Maybe I want to wait to 25%. Whatever your gut tells you, like, okay, I'm willing to, ride it out till it gets here, 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 or here, here, and here. That'll tell you like what kind of investor you are. As a general rule, if you're more impulsive, you don't have too much patience, you probably like to have smaller amounts of profits more frequently. And if you're a more patient person, you have high risk tolerance, you're okay with risk, you can withstand a lot of pressure, then you're probably a long-term investor. But like I said, there are ways to mix these together. What people mean when they say you don't want to use your emotions, like I was saying earlier, is that let's say you buy something for 10 cents and then you look at your computer screen and it's to 60 cents and your emotions like, buy more, it's going to keep going up, it's going to keep going up. When that should be a scenario where you might want to take some profits, or when you bought something good and your fundamental analysis says it's solid, your technical analysis says it's at a good price, and it tanks. Instead of looking at it as a buying opportunity, maybe you look at it as a selling opportunity. So you want to do this preparation first before you get into the position, or at least shortly thereafter. I'll give you guys another basketball analogy. We all know who Kobe Bryant is. Let's say you're practicing your turnaround shot, right? If you're guarding me right here and I bump you and I'm turning around to shoot this way, I want the ball away from you, because you're going to have to hit this arm to foul me. And then when I get here, that's when I'm going to release my shot. And if I'm hitting you this way, instead of bringing it up here on this side like I would on this side, if I'm hitting you, I'll give you a little spin. I want to bring it up on the left side of my head. So you have to hit me on this arm to get to the ball and foul me before I release it at the middle, up top, right? So you have to practice that over and over again. Just hit that turnaround. Practice bringing it up on the right side. Practice bringing it up here on the left side. Because if you get in a game and you try that move, and this is why coaches get mad when you do something you don't practice, because it's just like, why the hell are you doing it when you don't practice? If you get in a game, you're just going to bring it up right here. The defender's going to hit it out of your hand, right? So if you practice it over and over and over again, once game time comes, you're going to do it unconsciously. It's the same with investing. So you want to have a plan to get out before you get in, because by the time something happens and your emotions are getting involved, you'll probably make an irrational decision. All right, so now back to taking profits. Now, me personally, especially since I'm managing other people's money through my hedge fund, my goal is to be dealing with house money as quick as possible, right? So that way I'm in a risk-free trade. Because once you're in a risk-free trade, you're in profits. Then you can get a little riskier. Like you can, push the limits a little bit. So my first take profit will usually be after there's a 3 or a 4x. I'm taking out my principal plus 20 to maybe 40% in profits. Like I said, just so that I'm playing with house money. In addition to that, when you have a price trigger and you have a price target that you want to sell an investment at, remember, you will never be able to, you might get lucky sometimes, but you will never be able to sustainably time the top or predict exactly where an asset's going to go, right? So in this case, it's smart to have a conservative estimation and then an aggressive estimation. And you want to have your take profit strategy set up to where even if the conservative estimation isn't met and it's below it, or if it exceeds your aggressive estimation, you still have it set up to where you're able to scoop a good amount of cream off of the top and make some good money. I made a video on how I plan on turning $15,000 into $1 million by investing into maplefinance. And in there, I showed this exact take profit strategy. I have my conservative estimate, which is I think it'll reach a $10 billion market cap. My aggressive estimate is when it reached a $20 billion market cap. And I showed all 4 of my take profit levels, as well as once it exceeds my aggressive one, I'm withdrawing 50% every time there's a 25% increase. And at this point, I'm way past playing with house money. Last thing on price triggers, your price trigger doesn't have to be only and shouldn't be only on the asset that you're holding. You always want to look at the benchmark asset and whatever that asset class that you're investing in is. So for example, if you're investing into stocks, you may want to look at how the S&P, how the Dow, how the NASDAQ is performing, or at least the index within the industry of the security that you're holding. So if you're holding a technology stock, you might want to look at how the NASDAQ is performing. It's the same thing within crypto. If you're holding some altcoins, you definitely want to look at how Bitcoin and how Ethereum is performing as well. Because if the S&P takes a nosedive while you're holding an individual stock, or if Bitcoin or Ethereum takes a nosedive while you're holding an altcoin, there's a high likelihood, not guarantee, but a high likelihood, and I say likelihood, not guarantee, because you always want to play the percentages. Investing is a game of probabilities. And if you always doing what's probable, like what'll probably happen, that's how you win long term. If Bitcoin and Ethereum drops, there's a high likelihood that it's going to bring that asset down, and that may be a time for you to either short, if it makes sense, although short is really risky, or at least get out for the time being, because you can always buy back in cheaper. And it's not just when it drops. This is where chart mastery and technical analysis comes into play. I'll give you guys an example. Let's say if the S&P starts to get below my 62 EMA or my 200-day moving average, I'm probably going to want to sell my stocks, right? And there's multiple indicators. The next level of support or resistance is this level right here. If the S&P gets below this level and it's below my 62 and my 200-day, I'm probably going to want to sell a large majority of my stocks. Not all, because as we'll talk about, I believe in having a long-term bag that you don't touch for a while. But I want to sell a large portion of my stocks. Right now, Bitcoin's at 41K. Here's a super key level right here, this $35,000 level. If Bitcoin breaks this $35,000 level and it comes up and tests it as resistance instead of support, and then I see a nice red candle print, not just a candle print, but it closed on the weekly or the monthly, I'm getting out. Like, you look at what happened here. It broke here. It came back up. It tested our 200-day moving average and the $50,000 level as resistance. You saw what happened afterward. This red candle printed, and we're on the weekly. And then you saw this precipitous drop right here. It's the same on the upside as it is on the downside. So now that we've covered everything about the price trigger, the next trigger you want to look at when it comes to taking profits is a time trigger. So let's say you're invested into crypto. The important thing you want to look at is the 4-year cycle theory. Like every bull market that we've seen in crypto was started from the Bitcoin halving, which cuts the amount of Bitcoin coming onto the market in half. The block rewards that the miners gets cut in half. So if the demand just stays the same, prices have to go up because it's less Bitcoin to go around. So a good thing you can do is like, okay, after the halving, whatever assets I have, I'm going to sell a portion of it 2 years after the halving. That's a time-based trigger. Also, I recommend like splitting your portfolio up. It's a good idea, and I do this, to have a hodl bag where you don't touch for 5 to 10 years. Like guys, do you guys realize how much money you could have made if you held Facebook, Amazon, Netflix, Google, Apple for 10, 20, 30 years? A $10,000 investment will be worth multiple millions. All right, you hear this whole adage, time in the market versus trying to time the market. Take a look at this picture here. It shows by simply missing out on the best 10 days of the S&P 500, an investor can lose the majority of their overall return. So if you look at this first one, if you invested all days from January 2003 to December 2022, if you invested $10,000, your 10K will be worth $64,000 if you just sat in the market the whole time. Now, let's say you miss the 10 best days because you were trying to trade it. Like you're trying to trade all your portfolio. Well, now your 10K is only worth $29,708. So you missed out on half of what you could have got, basically. If you miss the 20 best days, and again, no one knows when those best days are going to be. That's the whole point. Your 10K will be worth $17,826. If you miss the 30 best days, $11,701. 40 best days, you're starting to be down in your investment. This is over 9 years. You would have $8,048. 50 best days, $5,746, and the 60 best days, you only have $4,205. I'm gonna let you guys in on another fun fact. Did you guys know that the portfolios that perform the best are actually portfolios of dead people or people who forgot they had an account or haven't touched their money in a long time? Basically, long-term investing outperforms trading and all other forms and types of investing. As a general rule, like you can be a sophisticated trader and know what you're doing, but just for the average Joe, because most people aren't good investors, you're better off just buying and holding. So Fidelity, which is one of the largest asset managers in the world, did a study in 2014. So they analyzed thousands of client accounts and broke them down into percentiles, trying to figure out what the top performers had in common. The result, the best investors were either dead or had forgotten that they had an account. A University of California study of 66,000 investors found that the higher a portfolio's turnover, the lower the average return. Those who traded the most lagged in overall market performance by 6.5%. As the researchers put it, trading is hazardous to your wealth. And it says here the reason's pretty simple. Impatience adds frictional costs. For anyone who shuns a buy and hold philosophy, brokerage fees and taxes quickly bite into the returns. The nature of compounding means that small disadvantages in any one year that may seem trivial at the time can take a big chunk out of your final payout. Now guys, this is why I say yield farming deserves a certain portion of your portfolio, because if you want to trade, you can use yield farming to, if you know what you're doing, you can outperform the trading fees that you pay 10, 20, 30, 40, 50 fold if you mix yield farming with trading. And I made a video on how to think like a pro yield farmer or market maker. But just to sum up time-based triggers, have a portion of your portfolio where you're trading and you're managing it actively, but also have another portion where you're like, okay, I'm holding this for 5 years, I'm holding this for 10 years, I'm holding this for 15 years, etc., etc. And also offers other cool things that you can do, like take out a loan against your holdings, or against your stocks or your crypto. And if you didn't know, you don't pay taxes on borrowed funds. The third trigger is the trend trigger. So this kind of is mixed with the price trigger. If the trend of the benchmark asset changes, like the long-term trend on the monthly, it might be a good time to get out. So like I said, if the S&P drops below a certain level or if Bitcoin drops below a certain level, you want to have that level that's going to make you get out before it happens. Because when it happens, you're going to try to justify like, oh, I'll stay in, it'll bounce back, da 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 da. Hey, it gets to a certain point. Investing is about how much you keep. They say it's harder to maintain than it is to get. Institutions aren't really worried about the next 10, 20, 30, 40, 50x. They're worried about maintaining what they already have. And it's a real mindset shift. And this is why institutions outperform retail investors. And they outperform retail investors when they have more assets under management, when it's harder for them to get in and out of positions, when they're paying larger fees than you, right? So it's not just because they have more money that they're outperforming and more analysts and a bigger team, although that's part of it, but it's because they're worried about maintenance versus just growth, growth, growth. Okay, so now that I covered these three triggers, it's a good idea to have it in your mind like, okay, if one of these hits, I'm selling. Or you can tier it. You can say if one hits, I'm selling 30% of my assets. If two hits, I'm selling 60%. If all three hits, maybe I'm selling all of it. And this does not include your long-term bag. Remember, your long-term bag is separated from your portfolio. And when you're taking profits, let's talk about how you actually take profits. Yeah, you can look on the chart, have some kind of notification that says, hey, your price target was reached, and then you can log into your computer and sell. But a lot of times you can't get to your computer. What if you're driving? What if you're on a flight? What if you're in a meeting? Like, you could be doing anything. So it's two ways to go about this. You can use a limit order, which says, hey, once price A is met, sell my asset. So like, let's say you want a limit order for Ethereum. You want to sell all your Ethereum when it reaches 5K. Well, you can have your Ethereum on an exchange, and once your 5K price level is reached, it'll sell it into whatever asset you prefer, USDC, for example. Another way to take profits is to do it through yield farming. And I've made videos on this, and it's basically the more impermanent loss you experience, you can use impermanent loss as a way to take profits for you. So you can make your range to the upside, so that way as price is going up, it'll literally take profits for you. And then once it goes out of your range, you can use something like aperture finance that says, hey, like let's say you want to sell your ETH at 5K and ETH is at, I don't know, 3K. You can set your range from 2,500 to 5,000. You can use aperture finance that says, hey, as soon as the $5,000 level is hit, get me out of the position. So now you're taken out of position in 100% USDC plus your fees. So you just made passive income to basically take profits. All right, so here we are at the end of the video. If you stuck around, I appreciate you. As promised, now I'm gonna give you the extra portion. And that is trading news, all kinds of news. So let's say you're buying a crypto project and you're anticipating a major partnership announcement, right? You hear the phrase, buy the rumor, sell the news. You set up your take profit strategy to say, hey, a news-based trigger that says, hey, if the price pumps by this amount because of this news, I'm gonna sell this portion, right? And you also want to keep your whole portfolio into perspective. Like, for example, remember last year when Facebook changed its name to Meta and all those metaverse tokens pumped? Well, not only could you took profit on Facebook, but you can take profits on whatever industry is involved in the news. So if there's some news about JP Morgan wanting to partner with layer 1 blockchains and all layer 1 blockchains pumped, you can take profits on all your layer 1s, because investing is all fear and greed. And once you hear a partnership announcement like that, people get greedy, but after they get greedy, they get fearful, and it just goes back and forth and back and forth. So a fence that goes up fast usually comes down fast. And if something spikes off of some news or a partnership, even if the fundamentals are solid, Warren Buffett said in the short term, the market is a voting machine. In the long term, it's a weighing machine. The voting is the irrational exuberance, the speculation, the greed. The weighing machine is saying, hey, the price to earnings, the profit and loss, the actual fundamentals is justifying the price. And this is why it took him so long to buy Apple. He went through the cash flow statement and he saw how rich in cash they were. So that was him weighing in if he should buy it. Another thing to keep in mind when you're taking profits is, let's say your portfolio has, 5 or 10 different altcoins in it and you're keeping track of them. And let's say 2 of them pumped and you still believe wholeheartedly in the other 8. Well, you can take some profits and you keep some as just profits. Keep the cash there, right? Lock in your profits. But then it could be a good idea to take that money and put it into what hasn't pumped yet. When that pumps, you do the same thing. So it's good to have a bunch of assets on your radar, but you give them a number of importance in terms of how convicted you are in them. And then you should only be in the assets where you're extremely, extremely convicted in. And once you make money off of those, then you can start going down the line. Not only is this going to help your portfolio perform better, but it's also going to help you better manage your assets, because better manage your portfolio, because if you're in all these positions, you want to keep in mind what's happening with the team. Are they firing people? Is there a new CEO? Is there a new partnership? Did they get hacked? Like, the more diversified you are, the harder it is to keep track of everything, especially if you're just a solo investor. And guys, this is way easier to do in the bull market because a rising tide raises all ships. Like, you can literally blindfold yourself, throw a dart at the dartboard and pick a winning asset. But in the bear market, you really have to be extremely disciplined with your portfolio. Guys, if you like this kind of content and you want to take your portfolio performance to the next level with a group of like-minded elite people, click the link in the description and book a free strategy session with us. We'll be excited to hear from you. Our Know It All Academy covers the mindset you need to have as a successful investor. It all starts with the mind. We teach you how to conduct proper fundamental analysis so you can pick high quality assets, as well as how to master the art of chart mastery so you can master your entries and your exits, as well as our intro to yield farming and our advanced yield farming. And we literally cover every strategy that you can deploy, the same ones that professional market makers have been using since the 19th century. And not so that you can deploy all these strategies, but just so that you can find the one that resonates the most with you, your goals, and your personality type. So guys, with that, I'd like to conclude this video. I really hope you got value from it. If you did, consider subscribing, drop a like, share with a friend. Let me know what you want me to cover next. But with that, I thank you so much for tuning in. I love every single one of you watching, and I'll see you in the next video. Take care and trade safe.